All right, it is right at the top of the hour at 2 o'clock p.m. Eastern. And this session is going to be with Neal Bawa. And his topic here is going to be the 2019 real estate trends update. I'm going to read his bio off the group here. I know he'll probably cover more of his bio, which I'm sure he'll probably do that because I know he's got a wealth of knowledge and a wealth of his background. So Neal is the founder and CEO of Grow Capitus, a commercial real estate investment company. He sources, negotiates, and acquires commercial properties across the U.S. for over 230 investors. His current portfolio exists of over 1,500 units, projected to be at 2,500 in the next 12 months, and includes multifamily and student housing properties in 7 different states. He is also the CEO of Multifamily U, an apartment investing education company. Neal, I'm going to turn it over to you, let you take it away, and I will be turning my camera as well as my microphone off. But if you have any questions or need me for anything, I'll be on the background. And I know you're familiar with the Zoom platform, so you can either answer some of these questions along the way, or you can ask everybody to hold to the end, and I'll jump on and tee them up for you.
Sounds good. Thanks so much for having me, Dan. I'm very excited to be here. Happy Saturday, everyone. This is a power pack presentation. It's about 55 minutes long. You can queue up your questions. I have the Q&A box open on my second monitor, and I can see your questions. Some of the questions I might defer to the end because I know that I'm going to answer them in about 10 minutes in another slide of my presentation, but lots of times I'll answer them as I go. So 55-minute long presentation, and let's jump in because there's a ton to cover. So the first piece of this is the agenda. With everything, you want to start off with the economy. You want to make sure that there's an understanding of what the jobs are doing, what the inflation and the unemployment levels are, what are the consumer confidence level. We're going to talk about the interest rate forecast for 2019 and how it's having a huge impact on our real estate profits. We're then going to move on to the single family forecast for 2019. I know this is a multifamily summit, but everyone's interested in single family. So yeah, as you can see from the little heading up there, the storm clouds are gathering, but it's not raining yet in most of the country. Then we're going to move into multifamily. And after that, I've added a new section because I get a lot of questions throughout the year from people about, will this apartment party continue? And I think that I'm about to answer that question for you in 10 dynamic charts. It's called The Story of Apartments. And, that's the most fun part of this presentation for me. But the most fun part for most people is the shootout. So at the end, I'm going to give you the best cities and states for in the US for real estate in 2019. All of these rankings are from the last 30 days. So there's nothing here that's been taken from 2018 or 2017. Everything is absolutely brand new. The research is just came out of the oven. And then I finish my presentations by giving you my picks for 2019. So I pick what I consider to be the best city to invest in 2019. And I also pick one underperforming city. It may not be the best, but I think it's going to have the most delta from where it was in 2018 to 2019. So I'll pick one of those as well. And I start off with the most boring slide of my presentation. We're not investment advisors. The seminar is provided for educational purposes only. All investments involve different degrees of risk. You should be aware of your risk tolerance level, financial situation at all times. You're free to accept or reject investment recommendations. All services we subject are offered to market risk, may result in loss to your investment. A recommendation is not a guarantee for successful performance. We cannot guarantee against losses arising from market conditions. And do not invest your money on our recommendations alone. Consult a professional advisor. So you already know that this is being recorded and is going to be available to you later. Questions, you can ask them whenever you like. All right, just a little bit about me. I run 2 companies. I believe that most of you, or many of you on the webinar know me, and some of you have actually invested in my past projects. I'm very passionate about multifamily investing, and I spend hundreds and hundreds of hours each year traveling throughout the country talking about data-driven real estate investing. That's my focus, data-driven real estate investing. My friends call me the mad scientist of multifamily. And I talk about how apartments are a great asset class for long-term wealth building. And I share the insights that come from this large portfolio and from my partner's portfolio. Most importantly, though, doing these kinds of webinars is something that I really, really love. This is the most fun part of my week. And before we jump into the presentation, here's a slide about a sampling, a piece of my property portfolio. We've been blessed to have worked with a very diverse set of properties. Oop, ran off. I think I need to fix something. So give me a second here, guys. I need to go back here and change transitions because they look like, yep, they've changed back to automatically transitioning. So Let me fix that, fix this, and save this, and go back to that slide. And now shouldn't jump away like that. All right. So from this property, which is a, oops, got to move this down. So you see this property, this Art City is a brand new four-story new construction building in Utah, to this glamorous camping or glamping resort in the richest zip code in North Carolina, to this very ugly multifamily in Vegas that is now 100% converted to a beautifully renovated property. We've learned a lot. Project like Woods Ridge Mar or Chelsea Place are occupied properties, very cash flow focused, where Rails on Main is a very fancy project focused on high returns at sale. The property next is in Jackson Park in Chicago, where President Obama is building a $1 billion presidential library and Tiger Woods is building a PGA Championship golf course. So we bring all of the learning from all the mistakes that we've made from this portfolio and from other properties that are not on this page to all of our projects, and hopefully to presentations like this. All right, time to get started. Let's start at the beginning. The economy and the demographics trend for 2019. Any story of real estate has to start with the economy. Without a strong economy supporting real estate, all forecasts would be useless. So before we jump in, let's spend a few minutes at the 30,000 square foot level. The good news is that the US economy or the US economic growth, what the bean counters call GDP, is pretty darn strong. So Q3 was 3.5%, which is excellent for a developed economy, far ahead of what the rest of the developed world is doing. Remember, any number over 2.5% growth is a good number. Now Q4 looks like it's going to come in very strong at 2.9%, and that's despite the stock market's conniptions. Remember, the stock market is not the US economy. So even though 2019 growth is projected slower than 2018, there's definitely no doubt that we will have the market to support both single family and multifamily growth. Now, consumers buy homes or they agree to pay higher rents when they're feeling good about themselves, their jobs, and the economy. And this orange arrow shows that consumer confidence numbers are extremely high compared to the last 15 years. So the foundation for 2019 is pretty strong, even with the economy slowing and that next recession getting ever closer. But consumer confidence is fickle. It can swing in a number of months because the biggest factor how we feel in how we feel are the jobs. And on that front, the economy has confounded even the most bullish pundits. Since losing nearly 9 million jobs in the 2008 Great Recession, the economy has created 20 million jobs. And what's really impressive is that we continue to create nearly 200,000 jobs a month, which is higher than anyone had predicted. Strong numbers, I must admit, much stronger than I thought they would be. And those 20 million jobs mean that the gap between the unemployed, that's the orange line, and the job openings, that's the blue line, has been reducing since 2009. And in 2018, we finally ended up in a situation where the job openings are higher than the total number of unemployed people. Whether you believe the government stats that you see in this slide or you believe the non-official statistics from shadowstats.com, what is clear is that it is much easier to find a job in 2019 than it has been since 2001. That's to the left of the graph. Now, keep in mind that while the graph above is good news for real estate, it's not all good news. For instance, the real estate construction industry is facing severe labor shortages, which are affecting both single and multifamily new construction. So that's great news for those of us sitting on existing rentals, but bad news for the country. Given I'm not in construction, I'll personally take it as a positive. And what about those young adults, those millennials? For years, people like me have been moaning and groaning that young people have no jobs and real estate needs these people to buy homes. Well, the good news is that over the last 4 years, young people have been getting jobs. I was really surprised by this graph, but the numbers tend to prove us all wrong very often. So that blue line is the unemployment rate for young people. The orange line, the green lines are unemployment rates for older people. As you can see, this huge gap on the screen between jobs for younger people and older people that we saw in 2010 is now way narrower in 2018. In fact, if you look at the graph, it goes back to 1982, and the only time that graph was this narrow was at the height of the dot-com boom. So young people don't have a lot to complain about when it comes to jobs. Now, I have to say, however, that the quality of jobs is another matter. Young people are earning a lot less than previous generations were, adjusted for inflation, of course. And so their ability to buy homes is lower than the previous three generations. Still, they've got jobs, so many of them will buy homes and others will rent. What's important to us in real estate is household formation, whether it's homeowner formation or renter household formation. We don't want millennials living with parents or living out of their cars. And the good news is that household formation is happening. We've had absolutely terrific household formation, especially in the last 2 years, from our millennials. So high consumer confidence, very high GDP growth, 20 million jobs, low unemployment. Well, unfortunately, all of that sounds like the perfect breeding ground for the evil hydra that we call inflation. In the past, all such expansions were snuffed out by this many-headed hydra. Take a look at this particularly ugly graph from Yardi. So in the 80s and 90s and 2000s, expansions were cut short because labor shortages caused hourly earnings to skyrocket, and that brought on the next recession. But what this graph is saying that we're actually not near that point yet. Emphasis on yet. Those three black circles show how spikes in inflation and wage growth caused the 91-2000 recession and the 2008 Great Recession. But while we now have inflation moving upwards, it's moving much slower than the last three times. Take a look at the circles and how sharp those lines are, and then look at the green box. For now, that inflation hydra is definitely well contained. In fact, all of the last three recessions all had wage numbers of around 4% annualized growth. At our current run rate, we are not going to hit that rate for 9 more years. So what that means is that it is possible that this expansion has longer to go than most people believe. The numbers clearly show that we're recovering far slower than the last three times, and inflation is not ending the party this time, yet. So bottom line is the US economy is in very good shape for the moment. The trade war could hurt us, and the labor shortages will definitely slow down growth. But the inflation hydra is in jail. Consumers are feeling good. Now, before I go on, let's talk about oil prices for a minute. Right? For decades, no discussion about the US economy was complete without a discussion on oil prices. After all, oil shocks were major contributors to the 70s recession and also to the 2008 Great Depression. Do you remember? Oil prices were $147 a barrel a month before the stock market crashed. Well, it's going to be different this time. The shale oil revolution has changed all that. The United States is today the largest producer of oil and gas in the world. The shale industry is so nimble that when the price of oil goes above that $65 to $70 a barrel level, they open up new wells that they've drilled in the past within weeks, putting a cap on prices. And while higher oil prices hurt you at the pump, the profits then flow into our own oil industry, resulting in more jobs and more money for US shareholders. This makes it much less likely that we will go into a recession because of an oil price shock. So yeah, it looks pretty good for the moment. But wait, those of you that know me know that there's always bad news from Neal, right? So there's always some bad news. This only feels like good news. Well, we just got started with the presentation, so give me a few more minutes to deliver the bad news. I have to say, though, that finding bad news in the short-term macroeconomic trends is much harder this year than it has been in the past. And I love to nitpick, but I have to admit the foundation is pretty strong. But there's still some bad news coming for the rest of you. All right, so some of it is right here. What's getting all the buzz is President Trump's very public battle with the governors at the Federal Reserve, our central bank. And the Fed has been very determined to reduce liquidity and raise interest rates, and they have now raised interest rates 9 times since 2015, quarter point each. Until a month ago, they seemed set on 3 more interest rate hikes in 2019. Would have been horrible news for real estate. However, they have now, in the last month, publicly softened their stance. Many governors have publicly stated that they think we're close to that equilibrium point where the economy is not running too hot and too cold, including Jerome Powell, who's our new Fed chairman. He indicated that last week. But the Fed doesn't actually set mortgage rates. They set an internal rate that influences mortgage rates. What other things influence mortgage rates too, like stock market crashes. So to start off, let's look at where the 30-year mortgage rates for home loans are now. And we started this year at 4.03%. And on December 31st of last year, fixed rates were at 4.64. So even though they're down from a few months ago, they're almost 2/3 of a point higher than a year ago. That makes a big dent in real estate activity, as we're about to see. Now let's look at 2019 estimates. Estimates and forecasts vary a lot, so I always present a number of sources. Up on the screen is Zillow's estimate. They think we're going to go to 5.8%, God forbid. If that happens, expect price growth, single and multifamily, to slow drastically. Now let's look at what others are saying about rates. So Realtor.com is at 5.5, not as bearish. Fannie Mae is at 5.5, and I just saw Freddie Mac's, and they came in at 5.1. So in the past, Fannie and Freddie, the two big lenders in the US, have been more accurate about forecasts. So I'm really, really hoping that they are right. I have to say, I personally find it really difficult to believe Zillow's forecast. As you'll see in a few minutes, they're very bullish on home price increases compared to, let's say, Realtor.com. But that doesn't jive if they think interest rates are going to go up so much from today's level of 4.6. So not sure what they're thinking. And that's my interest rate forecast for you. Let me move on to the single family forecast for 2019. Those of you that know me know that I mostly tend to focus on single family. This year I've added a lot of sections on the multifamily side. Firstly, because this is a multifamily group, and secondly, because there's so much differentiation between what the single family market is projecting and what the multifamily market is projecting. So growth is slowing, sales are slowing, especially in big metros like the San Francisco Bay Area or Denver or Seattle. Let's figure out why. Well, the first big factor is clearly the rising interest rates, right? So Darren Bloomquist from Atom Data Solutions has been reading the tea leaves. Well, he thinks that rising rates are responsible. In the past, we've had people who kept buying even when interest rates were 18% in the 1980s. But now your mortgage payment is a much bigger chunk of your salary, so a 1% hike in interest rates is a lot more inflation-adjusted moolah than back in the 80s. So let's first take a look at how mortgage rate hikes affected sales in 2018. Well, it wasn't too bad in 2018. As you can see, single-family home prices still rose on a national level in 2018. That's the blue line on the left. Condos have plateaued now at this point. They're not going up. Overall demand is down, which you can see on the right. So you see that demand dip there. So once again, I want to point out that this demand dip doesn't show a drop in prices. Prices are still going up on a single family nationwide level. In fact, there's no evidence of price declines anywhere except for one market. The San Francisco Bay Area is now seeing potential declines. The rest of the market is seeing a significant slowdown in sales volume, which could be a precursor to a drop in sales price, possibly. Now, in case you're thinking that I'm cherry picking data, here's another data point for you. That last slide had data from the National Association of Realtors. They projected that single family sales would decline by 4%. Here's some confirmation from LendingTree, one of the largest single family lenders. They point out that buying power is down 10% year over year. That's a huge dent. Now, they don't tell us how much of a decline, but the folks at Keller Williams do. They think that sales volume will decline 2% in the single family market. I'm personally predicting that the sales volume decline in the San Francisco Bay Area will be much larger, but that is a local issue, not a national one. Okay, and some of this sales decline really comes back to those troublesome millennials. As you saw a few minutes ago, they really can't complain about their jobs anymore. Their unemployment rate is now under 5%. But for whatever reason, they are still not buying as many homes as previous generation. As you can see from these three circles above, their home ownership rate is very anemic. That 4% difference between the year 2000 and now is millions and millions and millions of single family homes. Bad news for the country? Yes, but also great news for landlords, because that 4% difference is millions of renter households now that they have jobs and they're not living with their parents anymore. So bad news for single family often translates to good news for apartments. So with sales volume declining, will single family prices decline too? The flat answer is no. I'm looking at forecasts from various industry experts, and every one of them says that on a national level, single family prices will go up in 2019, but every one of them says that they will go up much slower than they did in 2018. For example, take a look at Realtor.com. They're betting on a 2.2% price increase. Zillow is even more bullish, which is puzzling at 3.8. Now keep in mind, both of these numbers are much lower. If you average them out, they're about half the home price increases in 2018. So those of you that are in the San Francisco Bay Area, none of this applies to you. Watch my forecast there. I do the San Francisco Bay Area health check, and you've got to really watch your market much more so than the national market, which is in a pretty good place. So bottom line for single family, the 2018 slowdown in home price increases will extend into 2019. Rates are still going to go up. Millennials are going to keep buying, though at a very anemic level. Home buying power is going to keep decreasing. There will be more inventory in the single family market, but we are not, repeat, not predicting it to be a buyer's market in 2019. We're predicting it to be a balanced market in 2019. With that, let's move on to multifamily. As you probably know, in the past, we didn't cover as much of multifamily in the real estate trends, but single family is weakening, multifamily not so much. I'm seeing an overwhelming interest in apartments. In fact, I don't think I've ever seen this much interest before in apartments in all the years that I've been doing these sorts of presentations. So I also included a visual story of apartment section. But first things first, let's start with a look back at 2018. Well, what can I say except 2018 really delivered? IMG's well-known analyst, Carlin Conklin, even called it exceptional. I wouldn't go that far, but I have to say it was a pleasing year. All of that is in the past. Let's now look forward to 2019. Well, the consensus actually is for more of the same in the apartment market. I put up one comment from a well-known analyst, but I have 6 or 7 more. They pretty much all say the same thing. They're quite bullish. Here's a 1-minute clip from CBRE commercial that does a really good job of summing it all up. And watch for their insight about money continuing to flood into the US for both commercial and multifamily, and it's coming from Singapore and Canada. The Chinese capital has backed off a bit, but other countries have just picked up the slack, making cheap debt and cheap equity very available in all commercial sectors. Let's take a quick look. Let me see if I can turn this on for you.
Richard, we just came out with our 2019 commercial real estate outlook, and notwithstanding the fact that we've been predicting the next recession is 2 years away for the last 5 years, it still seems as though next year is going to be good and maybe going into 2020. What's going on, Richard?
Well, it looks like inflation is under control, and that puts the lid on interest rate rises. We've also got very confident consumers, particularly in America, and we've got a business environment which is very favorable to investment. So all of those things add up to a really good year for growth.
One of the things that makes me particularly optimistic, not just about growth, but about the commercial real estate industry specifically, is capital markets, where while we're not at a record level for international capital flows, we're seeing a ton of it and a diverse amount of it, even though the Chinese capital has fallen off. We've seen our Canadian friends, which have always been our number one partner, pick it up, but also Singapore capital, which is not only greater in volume, but also the markets that they're looking at. That combined with a deep and diverse debt capital markets, where particularly non-bank financial institutions are providing very inexpensive capital, even when you get to some of the riskier parts of the capital stack, makes me very optimistic for 19.
Well, I would agree with you, Spence. We've got an emerging middle class globally who are saving more for their pensions, and that just gives you a supply of capital that's never ending.
Also, like multifamily in 2019, though I will say we are seeing some cautionary signs in the Class A segment where there's been a little bit of overbuilding. That said, B and C industrial, and in particular workforce housing, looks very attractive, notwithstanding some softness in some of the asset types, particularly A and CBD. We believe that 2019 is going to be a great year.
So their insight on multifamily, I hope you heard that. It's very critical to understand when you're making your investment decisions. There's definitely some evidence of overbuilding in many metros in the Class A rental market, but older Class B and Class C rental buildings still have very strong fundamentals. Srinivas, I really like your question, but I'm actually going to answer this a little bit later, maybe not at the end of the presentation, but great question. All right, so I'm going to give you 5 big numbers that are right now supporting long-term multifamily growth. And Srinivas, this is especially for you. What's really driving the strong fundamentals, right? So after all, with 7 years of rent increases, this cycle should be petering out for multifamily. We should be at 0 rent increases. We should be at negative rent increases. We built 1.5 million units just in the last 5 years. Nothing lasts forever, and there should be nothing that makes the apartment market bulletproof, right? Well, let's take a look. Our first big number is 10 million. Imagine a mountain as big as Everest. That's how huge this number is. In the history of our nation, we have never created 10 million new renter households in just 10 years. That's a staggering number. But given the big declines in the homeownership rate in the last 10 years, it was inevitable. Our second number is $500,000. So we're going to continue along this path. We're going to continue creating new renter households through 2025 at 500,000. We're only building 300,000 units and we're suffering. It's really hard to build 300,000. Each year we predicted 300,000. We never hit that number. We came in at 270, 280, 290. It seems that we can't build any more. Our third number is 15 million, and it's a sad commentary on our country that people are getting married less and are getting divorced more. Singles prefer to, tend to prefer apartments, so apartments are becoming part of a lifestyle choice. Never happened before. Apartment living is now generally seen as a more manageable expense and a flexible living arrangement than a single family home. Our fourth and fifth numbers are about student debt. In a single year, student debt grew by 6% to $1.5 trillion in a year when inflation was 2%. That number is now it was 250 billion 15 years ago. It's now 6 times higher. That's right, 6 times higher. The average debt, $40,000. And it's forcing young people to push back their plans to buy homes. And in too many cases, they may never get there. We're going to dive a little bit further into some of these areas in our multifamily report, The Story of Apartment in 10 Dynamic Graphs. Let's get started. And we're going to answer a question here. The question is at the bottom of your screen. Learn why workforce housing rent growth. Now, notice I didn't say multifamily. I said workforce housing, mostly Class C. That rent growth, why is it continuing to be far above 10-year and 30-year trend lines after 7 consecutive years of strong rent growth? Well, this first one actually frames our quandary. It's not going to give us answers. It is actually explaining our quandary. Look at the bars from 2011. Let me see if I can get a highlighter here. There we go. Look at these bars from 2011, here, through 2019. These bars are showing how many apartment units were delivered after the recession. As you can see, we delivered a heck of a lot of new units, right? Especially if you compare it to the 15 years before that. The puzzling thing is that the vacancy rate, which should have shot up with all those new units being delivered, that's the orange line in the middle of the page, well, that actually declined. Look at this. There's a decline while we're delivering the largest amount of inventory in decades, right? And magically, we ended up with higher occupancy rates. How the heck did that happen? Well, maybe this graph will explain. This time we're looking at combined single family and multifamily new construction. The blue bars are single family, the orange bars are multifamily. So you realize that multifamily supply is actually pretty small compared to the single family construction market. So here's what happened. In the year 2003, 4, 5, 6, and 7, so I'm going to circle those years, what happened was supply was actually higher than demand. So demand is this gray line down here, and supply are these bars up here. So higher supply, lower demand. And then that was part of the reason, by the way, that the crash happened. And then after that, we had a few years of balance, and 1 year where once again supply was higher than demand. And then after that, something interesting happened. Starting 2011, we started building very little. So look at this. This is the lowest year of building for many, many decades in the United States. It's 1/3 of the building that we had in 2006. I know that was crazy, but these numbers are insanely low. So as a result, for both single family and multifamily, we started developing a deficit, and this huge deficit here. So demand is up here and supply is down here. A deficit developed. We came back into balance for 2 years, 17 and 18, but by 19, because now the millennials have very, very strong household formation, whether it's renter households or owner households, we now have a gap appearing again. And because of that, rental prices just keep going. Another big factor is the monthly payment. As you can see, except for, let me see if I can find my cursor right here, except for right here in 2011 and 12, home payments are consistently higher than rent payments. And that gap has widened in the last 2 years, which is sustaining apartment demand. But that demand was really not across the board. The 3 lines on the graph show you vacancy trends by apartment class, A, B, and C. The blue line is vacancy levels for Class A new construction. So you see this here. And as you can see, as new construction, new apartments were built, slowly the vacancy levels kept going up because there was a glut developing in the market. CBRE mentioned it, right? Well, unlike past cycles, 93% of that brand new inventory was Class A. Only 7% was Class B. In the past, it's been 20 to 25%. So that orange line, the class is Class B. You didn't get any new Class B inventory. So slowly Class B vacancy kept declining. Well, but the big one was Class C. Since 1999, when President Clinton ended the HUD development program, we've built almost zero Class C housing, almost zero. And given that the Bs are also in demand, very few of those older Bs were rolling over and becoming Class C, which has happened in the past. So as you can see, Class C vacancy went from a very high 9% to under 4% today, which I believe is historically the lowest number. And this is another reason why Class C has extraordinarily high rent growth and continues to have that rent growth. Now, obviously, rent growth goes down when new apartments are delivered. Now, you can see that on the right side of the chart. Everything went down. A, B, C, everything went down. But what's amazing is what happened after the glut. In the past, after the new apartments came into the market, rent growth in past cycles was 0, -1, -2, -3. You know what's amazing this time? That even the Class A levels, that's the dark blue line, are still, look at that, they're back up to almost 3%. Historicals, 2%. Historicals after a glut, -1%. Look at that difference. Class B is doing well. Look at Class C. They went up to a crazy 7% level. In the multifamily industry, when we get 2.5 to 3% rent growth, we hit our doubling, of people's money. We tend to hit that. Well, at 4%, it's champagne. At 5%, we can't believe our freaking luck. And here you go. The United States is still averaging above 3% after the delivery of 1.5 million apartments. Here's what's really good news. This is the United States. So it's got really weak metros like Detroit, and there's got St. Louis. You know what the average is for the really powerful metros? The Atlantas, the Las Vegases, the Phoenixes, the Orlando. It's above 6% month over month, including last month. I've got numbers for last month, and they're all over 6%. That's amazing numbers that we really have not seen anywhere before. There's really no historical data point in the past to look at and say that things like this have ever happened. Now, syndicators like me, who buy a lot of Class C apartments, were really worried that that incoming supply that came in 17, 18, and a little bit of 19 would take renters away from our properties. Well, that didn't happen because we didn't understand something, that only 2% of median income households can afford the rents of these new apartments that are being built today, which is why the existing stock of old apartments has become such a price, and everybody wants to get their hands on the old apartments. Now, it's not like the apartment developers have not tried to compete. They have. As you can see, in the last 10 years, as rents for new apartments went up, and that's the blue line right there, so it's going up, right? Well, they also tried to compensate by slowly decreasing the sizes of their apartments down about 50 square feet in just 10 years. They were trying to shrink them to make them cheaper, right? And it wasn't just the apartment guys. Single family properties are also shrinking because the cost of construction, both labor and materials, is rising far faster, far faster than inflation. How much faster? Well, here you go. This graph explains why it is so difficult to put the genie back in the bottle, why it's so difficult to fix this problem. Look at the crazy increases in construction costs over the last 26 years. The Chinese are building a brand new New York-sized city every few months. So are the Indians. So steel and concrete and glass and all the other stuff that we need are not cheap anymore. This graph shows that a room that could have been built for about $40,000, maybe $43,000 in 1992, now that same room costs $110,000 to build. We're not talking 2% inflation here. We're talking 4 or 5% year over year for decades. And that, ladies and gentlemen, makes it very difficult to build single family or multifamily for the common man. The common man simply cannot get new housing today because these numbers are very, very stark. So what's happening? Well, people like me who are taking control of those apartments for the common man are putting themselves in a position to raise rents. As you can see, historically, rents rise at the same level as the consumer price index. Look at that. It's almost clockwork, and that goes all the way back to 1970. At no point there did rents rise significantly faster than the consumer price index. Well, take a look at the last 5 or 6 years. That connection between rents and the consumer price index is broken. And it's broken because the cost of construction is completely out of whack and is not going to come back to norm. There is no return to norm for construction. This is the new norm for construction prices. We took all the cheap steel. We took all of the cheap concrete. We had cheap labor from China. Now they're focused on building their own economy. This is the new norm for construction. So the genie can't really be put back into the bottle. And that leads us to our last graph, which is about apartment prices. We measure these prices in dollars per unit or per door, as the industry calls them. And if each door cost $100,000 in 2008, that back here, now each door costs $160,000. And this is average, right? This includes B and C's in there. It includes brand new buildings as well. This is the average, $160,000. And this is what makes it super lucrative to buy older 1960s, 70s, and 80s stock at right around this price, $60,000 a door, spend $10,000 a door fixing them up, and then renting them out to that common man who is completely left out in the cold because of all these sad trends that I showed you in the last 9 graphs. And that, I believe, is the biggest, the most powerful, and the most accessible opportunity in real estate over the next 5 to 10 years. Okay, well, it's time to move on to the grand finale. Let's look at the best cities in the US for real estate in 2019. And these top picks are from Forbes and Realtor.com and from Yardi Matrix. I'll be adding more of those on my website. I don't agree with every one of these picks, but the vast majority make a lot of sense. Now, before we do that, let's spend 2 minutes talking about my company's offerings. You didn't think that you were going to get away without a pitch, did you? Well, we, as you can tell by now, are into apartments. We do both new construction apartments where it makes sense, and we do existing apartments. Our bread and butter is existing apartments, though this one up on the screen is a new construction project that is now projecting 26% annualized returns. This one's for accredited investors only, but the vast majority of our projects are for accredited and non-accredited investors. If you're interested in investing and you're a non-accredited investor, reach out to us. We have 3 projects, I believe, that are available for non-accredited investors at this point in time. So just a little bit more about this one. If you like student housing, remember student housing is recession resilient. Why? People go back to school when they get laid off. So student housing, especially graduate student housing, tends to do really well in recessions, and there's definitely one coming up. For those of you that are actually interested not in passive investment, but in actively making apartments a part of your life, I can help you there. I help people become financially free with real estate, and I teach them how to invest in apartment buildings. And I do this because of this fact. By now, I think you're convinced of this. It's one of the best asset classes for long-term wealth accumulation. And towards that, I teach the last honest, I'm going to highlight this word, apartment boot camp in America. And it makes you 3 unique promises. And it keeps those promises. The first promise is that the training is very eye-opening. Hopefully, I've been opening your eyes for the last 40 minutes. Training's eye-opening, specific, it's tangible, it's meant to be used right away. And you can see from my students, they're talking about the fact that veterans would have liked them. They love the specific tools. They love the fact that they can put these tools into practice right away. The training is pitch free. In fact, this is the pitch for the training. There is no upsell, no coaching, no mentoring, no people running in the back of the room trying to drag you to the back of the room and make you max out your credit cards. You will be pitched nothing during the boot camp, not even for 1 second. You can see students over and over talking about the fact that they were pitched nothing. They just spend time focused on education. And by the way, the education is less than 10% of the industry price. That's right, less than 10%. And I am not kidding you. The third one is it's filled with technology shortcuts, things that I've invented over the years, secrets and strategies that you've never seen before, even if you've gone to those $40,000 boot camps. My ideas on how to use virtual assistants and mega marketing strategies to create tens of thousands of leads for my properties, tenant leads, was eye-opening for students. Many students that have, this student has taken 5 of these boot camp, and he liked this much the most because of the immediate ability to influence the marketplace and get going. So you'll learn how to syndicate, you'll learn how to buy multifamilies and how to manage them. You learn the best and worst metros in the US and how to figure those out for yourself, not me giving you a list. You learn how to figure out the best neighborhoods in a city. Remember, even great cities, powerful cities, have horrible neighborhoods, and you learn how to figure those out. You learn how to find brokers, create relationships with them, and get them to give you off-market properties. You learn how to do underwriting, how to evaluate properties. You learn how to find the right property managers and then how to manage them, which is more important than finding the right people. And then you learn how to raise private money. So specific tips on how to raise private money step by step, 10 different strategies, and then so many bonuses. My Facebook student-only group where students are doing deals. As soon as you log into the group on the first day that you buy, you'll immediately see that they're doing deals. Recordings of the session, a digital student resource kit, data reports for every metro in the US, a private coaching session with me, and lots and lots and lots of benefits. So if you're interested, we've got a promo for this particular event. You can go to multifamilyu/bootcamp. It's currently early bird pricing, so you're already getting a big discount, but you can get another $400 off. And once again, you can take this from anywhere in the United States. It's live hands-on training. There's labs. It starts March 4th, 6 live sessions in the evening. So you can take this from home. It is designed to be taken from home. And once again, it's a 10th or a 15th of what you would typically pay. Okay, I'm done with the shameless sales pitch. Now it's time to get back to the best cities in the US for real estate for 2019, single family, multifamily, new development. Now we'll start with the single family top 10 list, and this one's from realtor.com. Coming in at number 10 is Boston, the oldest and the lowest cap rate market in the US. Realtor.com is predicting 4.6% price increase. This is a supply constrained market, so I think they're right on. Next, they're predicting that Miami will have 5% price increases, once again, supply constrained. The first of my absolute favorites, Boise, Idaho, shows in at number 7 with projections of almost 7% price growth. Another one of my favorites, and a city which is highlighted in yellow because I own there, has projected price increases of almost 8%. Only one city in this list is higher than 8%. At number 6 is Bridgeport, Connecticut, a saving grace for a state that has very substantial real estate price declines. And at number 5, we see Phoenix, Arizona, no surprise, a city very much on the upswing. At number 4 is Chattanooga Metro, and my newest investment happens to be in this metro, so that's why you see it in yellow. Coming in at number 3 is an absolutely bizarre entry. El Paso, Texas has never been on a top 10 list to my knowledge, and somehow makes it to number 3 with only 2.5% projected growth. Look at that number on the right. Wonder who paid off who there. I have no idea how it got onto this list. Coming in at number 2, no surprises, second year in a row, is the city of Grand Rapids, Michigan, which has the highest projected price increase in this chart at 8.2%. I'm pretty sure they'll achieve that easily. But I am beyond delighted with the city that is at number 1. Anyone who's listened to my presentations last year or the year before know that I frequently talk about a unique corridor of opportunity in Florida. It's a 140-mile stretch of Freeway 4 that runs from the city of Deltona, goes through Orlando, and then through Tampa and ends in the city of Bradenton. Guess where the number 1 city on this list is? Well, it is smack dab in the middle of the corridor of opportunity. It is the city of Lakeland, Florida. So really happy to see the corridor of opportunity that I've been talking about for 2 years win at number 1. Now, I like to do 2 different contrasting lists. So here's my second list, and you'll notice that the cities are different. Very few of them will be overlap. That's because the way that they calculate it is different, right? So coming in at number 10 is a market I'm not fond of at all. Memphis, Tennessee does have very home prices that are very reasonable, and you can see that in the last column on the right. So green is good, red is bad when it comes to affordability. So one of my favorites in a city that I'm very, very heavily invested in, Atlanta, makes it to the list at 9, also very reasonably priced homes. Philly comes in at number 7, a city on the rise. Fort Worth is a city that I'm invested in, comes in at number 6. And then Indy comes in at number 5, followed by Cleveland, Ohio at number, Indy's at 6, Cleveland at number 5. That's a big surprise to me, by the way. Charlotte, North Carolina, very powerful economy, comes in at number 4. And number 3 is another favorite of mine, Jacksonville, and this is the city that my next project is in. And another North Carolina city, Raleigh, at number 2. And at number 1, well, the corridor of opportunity wins again, with Orlando, Florida at the top of this second list. So both lists won by a city in that corridor of opportunity. Maybe I should patent that phrase. What do you guys think? So jokes aside, what I'm proud about is that I have investments in 5 out of these 20 cities, and I'm working on a project in the 6th, that's Jacksonville, and you might hear about that in a week or so. So that's single family for you. Time to move on to multi. And this is rent growth. As you can imagine, on the multi side, what we focus about is not really price appreciation, because cap rates don't tend to move up that much or down. And so we're really focused on rent growth when we're looking at cities. Atlanta comes in at number 10. And now notice this, very important, is that the rent growth that's on the second side on the green here, Atlanta shows at 3.3. This is not Class C. This is Class A, B, and C together. Projections for 2019, Atlanta currently has Class C growth that is almost double this level. So for almost every city in this list, I would say all of them, you've got to increase that growth level if you're looking at just Class C. But the numbers are pretty awesome even at a Class A or B level. Denver coming in at 3.4, but huge amounts of construction. So please note, this is one of the most dangerous cities to invest in right now in America. Raleigh, no surprises there. North Carolina is a terrific market. Orange County, once again, no surprises. Los Angeles is super expensive, super supply constrained, and so Orange County is going up there. Twin cities, that's St. Louis and, St. Paul and Minneapolis. Once again, no surprises. Phoenix, just an amazing, amazing market. Los Angeles, very, very heavily supply constrained. For those of you in California, the party may be over in the San Francisco Bay Area, but there's no evidence that the party is anywhere near over in Southern California. Seattle coming in at 4%. Again, a city, you notice that red number on the right? That 4% on the right? That's me warning you, large amounts of incoming supply on the multifamily side. So these numbers may not hold. So Seattle, I think on the multifamily side is a risky market at this point in time. Las Vegas, an absolute favorite of mine, terrific growth. Class C growth is at 8%, which is the highest in the United States. Amazing city, and look at that, not a lot of supply coming in. This is the highest number I've seen. It's still only 2%, which is a very reasonable amount of supply for a market that's doing so well. Orlando, quite a bit of supply, but I don't think this city is risky. Why? Look at that job growth. Look at that middle column, 4%. Do you see any other city in this list at 4% job growth? If Orlando continues to produce such a spectacular number of jobs, it can absorb 3% of incoming supply. It can absorb 5% of incoming supply. So I think it's going to continue doing really, really well. Dallas coming in at number 2, I believe, on this list. And once again, a little warning there. Look at that incoming supply number. So we've got to be a little careful, but Dallas also has very strong job growth. So it might be able to accept that and still do well. Inland Empire coming in at number 2. Inland Empire is east of Los Angeles, is east of, let's say, Irvine. So very powerful area. That's a strong economy that's doing well. And at number 1, second year in a row, is Sacramento. Why is Sacramento continuing to do well? Not enough supply. Look at those numbers on the right. I think Inland Empire and Sacramento are the least risky cities, not just in California, but possibly in the US, because the incoming supply is really, really low, which allows people like us to keep raising rents. We're not afraid of all those Class A units coming in and pushing down the rents. So that's it for multifamily. Sacramento, Inland Empire, good picks. So is Las Vegas, Orange County, and Atlanta. These are really, really strong cities to invest in for multifamily in 2019. Now, I know that a lot of you guys don't get into new construction, but I had to put this up there because of this thing called opportunity zones. If you haven't heard about this $500 billion opportunity that is, no pun intended, that is absolutely enormous, well, then you should be looking at it. It's incredible. I'm really happy to see my latest investment city, Jacksonville, is in the list. For those of you in California who are now looking very glum because everything is going downwards, well, there is an opportunity, a very strong one, in the San Francisco Bay. The East Bay, and I live in the East Bay, is a terrific opportunity for opportunity zones. They have a whole bunch of them, especially in Oakland. So if you're inclined to new construction, take a look. For all of the rest of you, take a look at Salt Lake City if you want to build something. Take a look at Austin, Texas. Maybe not Seattle. A lot of incoming projects there. Same for Miami. But look at some of the others here. Nashville also has a lot of new construction. But construction constrained cities like Charlotte, like Salt Lake City, like Austin are great places to look at if you are on the multifamily construction side. All right. So my picks for 2019, it's time for me to put my foot in my mouth, which I did last year. Last year actually worked out well for me, so we'll see how this works. But before I give you the last slide of this presentation, my question is, how do you continue the learning journey, right? So you've been to this summit. What if you wanted to continue this journey? Well, I have a massive free library of learning content. So what you just saw was about 100 articles, dozens of reports, single family and multifamily presentations, videos, articles, ranking reports, trend reports, so much more. And what I do is each month I update this library and I give it away for free now and forever to anyone that listens to my presentations. So if you want, before the end of this presentation, whip out your smartphone and text the word RE Toolkit, lowercase, RE Toolkit, to that number on the screen, 44222. So write that down, text the word RE Toolkit to the number 44222, and you'll get access to this. So here's the entire toolkit. And again, I update it almost every week, sometimes every 2 weeks. So you'll see this presentation, so you can watch it whenever you want. The full CBRE video, I gave you a 1-minute version of it, but it's a longer video. And then lots of information about what's happening to the marketplace. Usually by the end of the year, there's 20 videos here. Trend articles, housing market outlook from both the lenders and also from investment providers. Impact of tax reform, affordability, and then one of my favorites, future homeownership trends, which basically is why we're a lock in multifamily. This shows the 3 decades of homeownership declines that are coming in. Not a report by industry analysts, but a report by a university. They're the best at tracking homeownership levels. Reports, trends in real estate, some of them amazing trends that you really wouldn't think about, like co-living and co-working, that I think are really powerful trends for the next 10 years. And then every other ranking report that was used in this presentation and many that didn't make it. And then every other trend that I like. It doesn't matter whether that trend is in multifamily. You'll see senior housing, you'll see student housing, you'll see storage and industrial as this gets populated throughout the year. And once you subscribe, basically, once you do the thing on the smartphone, when there's an update here and new stuff gets added, you'll get an alert. And then some of the presentations, these change throughout the year that we present. There's 50 plus presentations. And then for all of you multifamily guys, city by city trends, cap rate surveys, cities that people are moving to, so that this data keeps getting updated. I just started 2 weeks ago, so the list keeps getting longer and longer and longer. So you get access to that. Just text the word RE Toolkit to number 44222 from your smartphone and you'll get access to that toolkit. All right, let's end the presentation. I give you 2 tips. The first tip is for an underperforming market that I think is now coming into its own. And that market for 2019 is Kansas City, Missouri. Not Kansas City, Kansas, Kansas City, MO. And one of the reasons is that I am seeing a massive amount of new development spend. Those apartments won't come to the market for a while, but I'm seeing this. Development guys tend to be the most savvy when they're looking at long-term growth. They tend to look at the macroeconomic numbers, they look at the socioeconomic growth, and they're really all in on Kansas City. There's a lot of other indicators. If you want to talk with me about this, let's talk about it offline. But I think Kansas City MO is a really, really good market for 2019. And then my tip for the best market in 2019 is the same as my tip for 2018. I don't think this market has peaked yet. It is the potato city, Boise, Idaho. And here are 9 reasons. Incredible inward migration for other states, very high livability. It's on so many best places to live lists, great job growth, very low unemployment rate. Look at that, 2% unemployment. That's crazy. 8th safest city in the world. Number 1 single family projected rate growth in the US, and this is from Ingo Windsor, a friend of mine who runs Local Market Monitor. Highly regarded schools, beautiful outdoors, low taxes. What more can you ask for? Well, there is one thing I can ask for, and that is projects. Boise has no projects. For those of you that go there and have new construction projects that you might need equity for, come talk with me. I'd love to invest in Boise. I haven't managed to do that so far. And that is our show tonight, folks. I hope you liked it. But what you learned today is a tiny, tiny, tiny fraction of the incredible and free knowledge that is available on this site, multifamilyu.com. From all of these speakers and dozens more, we're planning 50 plus webinars this year. We'll hopefully have Dan Hanford presenting to us. So keep coming. Time for questions.
Great. Well, let's go ahead and open it up for questions. I know, I think you might have answered the questions, some of the questions that were already on the Q&A box, but
Sure.
Manish is asking, what is the driver that you're seeing for Phoenix?
Well, I think the big driver for Phoenix is that western cities. So if you look at the western seaboard of the United States, some of the most expensive cities are there. So Portland, Seattle, San Diego, Los Angeles, San Francisco Bay Area. These cities are so super expensive that jobs, not necessarily technology jobs. Yes, Phoenix is doing well with tech, but even non-tech, companies are actually moving. And as they're moving, they're picking cities that are still on the western side of the United States, not the western seaboard, but the western side. So Boise, Idaho gets picked, Phoenix gets picked, Las Vegas gets picked. So if you look at the cities that right now have amazing growth, they all appear to be 1.5 hour flying time from the western coast. And so it's a very consistent trend. So it's not a Phoenix specific trend. It's a trend of companies running away from expensive blue states.
Good answer there. I like that. It's one of the things that we don't always look at is that, and one of the things I wanted to touch on about Boise is that it is definitely an interesting market. I had never been there, but 2 years ago I took a trip to Boise. It took me a little while to get there because from South Carolina, you got to take a plane from Columbia to Atlanta, then from Atlanta to Seattle, and then from Seattle, take a little jumper over to Boise. So it's pretty much an all-day trip, for me to get over there. But I really do like that market as well. I think it's a great pick.
Well, one interesting thing, Dan, is yeah, you had to take puddle jumpers to go to Boise 2 or 3 years ago, right? But from the western coast now, there's now like 5 or 6 flights going to Boise, where before you had one pick for the day. Obviously, the demand for people going there from the San Francisco Bay Area has spiked dramatically compared to what it was 2 years ago.
Yeah. Well, that's great. Well, I always enjoy your presentations. I know you and I first, when we met together, we met at an event in Atlanta where we shared the stage together, and looking forward to continuing to follow you and doing some deals as we move into 2019. Got another question that comes in here, and it says, the crash is coming. Do you offer investors 10 years or 5-year opportunities?
The short answer is that all of the opportunities being offered by all of the syndicators are 5-year and 10-year opportunities. So I'm hoping that your question is really about locking in interest rates. So about 2 years ago, 70% of the loans for my properties were bridge loans. Now 70% of those loans are 10-year fixed. And there's only one reason for that. I want to survive the next crash. You can see the positive trends for multifamily. None of them will mean anything if you've got to adjust your bridge loan in the middle of the recession. Maybe at the beginning and the end, you're fine. But in the middle of the recession, what will happen is that your property will still be doing okay, right? Because it's a Class C multifamily. But you'll see, you won't be able to raise rents. But what will actually happen is the value will fall. Because what happens is multifamily cap rates will decline during the middle of the recession and then sharply come back up. So you don't want to be that unlucky guy that gets stuck with a refinance right in that middle here and have to do millions of dollars of cash call or some crisis sale. So in my mind, that is the biggest single risk. I still offer projects that have bridge loans, but we talk to all of our investors saying, look, bridge loans will offer higher returns and they come with a substantially higher risk. And yes, we are now offering more and more projects that are 10-year fixed. And these are not just 10-year fixed loans. These are projects that run for 10 years. There's a big difference. You can have a 12-year loan and still have a 5-year timeline where when you sell after 5 years, the new guy still has 7 years left on the original loan. So he has to assume your loan. It's still a 5-year project. But what I'm talking about is we now offer 5-year project, 5-year project, 10-year project. And we're saying we're going to hold for 10 years. And we're doing that because of this concept of crash. Just so you know, I don't think a crash is coming. I think a recession is coming. I think that the big worldwide crash is inevitable, right? If you don't understand that, you need to understand macroeconomics. We cannot pile up trillions of dollars of debt and have everybody else pile up trillions of dollars of debt without a crash at the end of it. But it's not here yet. These things take longer than everyone thinks. If you want to study how long it can take, the best economy in the world to study is Japan. Japan is an economy that has had negative population growth for decades. It's an economy that has had negative GDP on and off for decades. It is now at 250% of debt when it comes to their GDP. We're at 104%. And by the way, we are the reserve currency of the world. We could go way beyond 250 because we are the reserve currency of the world. They are not. And they're at 250% of GDP debt, and they still have a functioning economy. So the point is this. Yes, it ends in a crash. But for those of you that thinks it ends in a crash in the next 2 or 3 years, I think that you don't understand macroeconomics. These things drag along for decades and decades. But the direction that we're going in is a bad one. It just so happens that that bad direction is a better direction for multifamily and a far worse direction for single family. So I understand that. That's why I'm in the multifamily business. If 5 years from now that direction changes, I'm going to go into something else. Might be storage, might be industrial, might be mobile home parks.
Well, and I think like what you had mentioned there too is that, you know, even though you might get into an investment, and this, when we tell our investors this as well, that, you know, we might project a 5-year, you know, plan, and we might be holding a 10-year note with a, you know, 3 or 4 or maybe 6 or 7 years interest only, but we're going to project a 5-year hold on that particular investment. But we tell all of our investors that we're not going to be stupid. Like if we get to that 5-year mark and we're in the middle of a recession, it doesn't make sense to sell. We'll hold on. We're going to hold on through it. So we're not going to just, you know, exit just because that was what the projection was. But those projections are there to be able to base what the returns are and the IRR. But all that stuff's going to change based on the economy.
Absolutely. And you can take that comment, you know, that Dan's comment really applies for all of the syndicators in the US. I don't think that anybody is going to be silly enough to sell in the 5th year just because he told you so. I think that and he might sell in the 3rd year or the 4th year. What if the property is reaching projections before the 5th year? So the truth is, when you invest into a multifamily, you're investing into a business and professional managers are managing it. They have to make decisions that are best for the investors. And that may mean a longer hold, a shorter hold, a second refi. All of these scenarios are really open. But I think that, yes, if you're looking for longer holds, you should definitely go with syndicators that are telling you that they're going to be holding a particular property for 10 years. That's definitely a big benefit, yes. And I want to take Srinivas's question, you know, because he asked that a while before. How do you explain income inequality and almost $1 trillion deficit that we are approaching? Well, I think the answer is fairly straightforward. For decades, we've been spending more than we have. And when you spend more than you have, that tends to spike income inequality and it tends to spike deficits. At no point in our history have we had sub 4% unemployment with $1 trillion deficits. In the past, we had not deficits, we had surpluses when we were at 4% unemployment. But this trend will continue. I think this is not the US. This is not us blaming our politicians. Look at anybody else's politicians. The European zone, China, and Japan have it far worse than the US. This is about politicians not doing what they were supposed to be doing. And at this point, nobody can really go back to the way things were and be fiscally responsible. Even the Republicans don't try, right? Even though that's their platform. And that's because it really is happening across the world. Yes, at some point in the future, it leads us to a crash. The question for you is, if there's a crash, what happens to real assets? Well, first their value goes down, it plunges, but then their value goes up because gold and any other kind of real assets, timber, by their very description, real, are fixed. They're tangibles. So what'll end up happening is when you have a crash, the Fed will go back, they'll lower interest rates, they'll crash them again, and then basically the same cycle starts again and runs for another decade or two. If you're holding 10-year fixed loans, if you're not holding bridge loans, you're going to make your way through that and then benefit from it when the Fed again throws rates down, and once again you've got that asset bubbles being created. The only way to get out of the next crash is asset bubbles. The Fed knows that. That's what they're going to do. Why is that such a bad thing for multifamily people?
And the last question here that's coming through, it doesn't have to be the last one. There's just the last one that's on the list right here. So if you have any other further questions for Neal, take the time right now to type into the Q&A box any questions that you may have. I know a lot of times when you go through his presentation, it's like drinking through a fire hose, and so you got to take some time to digest
That's right.
it all. So
Yep.
I would definitely suggest you continuing to follow him because he definitely has a lot of good research in the multifamily space. Manish is asking about your online boot camp. Do they get access to you over the phone for questions, and how available are you for your students?
So the short answer is, Manish, I'm not teaching that $40,000 product. So it's a couple $1,000s. After the boot camp, you'll have a call with me and we'll go over what you want to do. And then I will be monitoring you through the Facebook Secret Society, which I monitor on an ongoing basis and answer questions. But the key thing about this boot camp is because I'm not trying to sell you a mentoring package that's tens of thousands of dollars, I actually have students connect with each other. So what will end up happening is my community is very deeply tied together and students are doing projects with each other all the time. They're going to answer a bunch of your questions, or I will through the Facebook Society. But since I'm not selling a mentoring package, you can't, call me up at any point and ask me questions. No, that service basically does cost $20,000 or $40,000.
I don't get to call you Neal?
You do, Dan. You're special. But I do have very high chiropractic bills, so there's a give and take there.
That's true. That's true. So another question has come in here about tertiary markets like Tucson. Do you track those tertiary markets? And I know you were optimistic in the past for Tucson.
I continue to be highly optimistic for Tucson. What we have seen is this, that if there is a primary market that is doing really well, its secondary tends to have a 10-year run. I'll give you examples. Tacoma is having a run because of Seattle. Sacramento's had a run for 5 years because of the San Francisco Bay Area. Guess what? There's only one real tertiary for Phoenix, and that is Tucson. And guess what? I'm doing a project there. So the short answer is I'm putting my money where my mouth is. Absolutely believe in Tucson. It has had a very ragged past. I mean, go back and look at Tucson from 20 years ago. You would not want to live there. But things are changing there. So go to Tucson. That city is changing. Its crime levels are dropping like crazy.
Another question here is about the availability of passive investor funds. How do you predict the future availability of those funds, and in which financing remainder of the cost of the stack after the bank loan?
Ooh, I'm not sure I understand that question.
The last part is a little bit confusing, but I guess they're trying to figure out, are we going to ever run out of passive investor funds?
No, and I want to, obviously you have access to this presentation, right? I want you to go back and listen to that 30-second segment with the CBRE guy. So understand this. We are once again the strongest economy on earth, right? Obviously because we're the biggest oil producer on earth, but lots of other reasons. There is no economy that comes close to ours. The United States is truly blessed once again in that every month, tens of billions of dollars of money flows into our debt market, our capital markets, and our commercial real estate. Tens of billions of dollars. And those people that are bringing money in from Singapore and Canada and Qatar and all of these other places, they actually have lower expectations of return than we do. They're perfectly fine with cap rates of 4, which is absurd to us, but not to them, because they're looking for capital preservation. We are the best capital preservation country on earth. So what's nice is we don't just have the money from our people. We actually have money from hundreds of other countries flowing into the United States on an ongoing basis. That money sometimes goes away when there's a crash or there's something going on in the marketplace. But one thing that we've seen is it always comes back.
Well, one thing I wanted to share with you too, Neal, and the people who are watching is yesterday morning when I did my keynote, I gave some statistics because I was talking about the mindset of a high net worth investor and went through a lot of the different, nuances of investor relations and communicating and whenever you have deals ready, going through the, the before, the during, and the after phases of a deal flow and how you present that to investors. But one of the things that I talked about was the availability of those passive investor funds because, we sometimes think that, there's not anybody around that has any money, that there's nobody around. Well, it's because of the people you're hanging out with, right? It's part of the people that you're around.
Change the people that you're around, because honestly, one of the key things that I say these days, Dan, is there's never been this much passive money available. But on the other side, it's never been as hard to find good cash flowing properties. So your challenge today is not money. I think that's a mindset thing and that's a first project thing. And once you get beyond those two things, you're going to be complaining about the fact that there's not enough good properties in the marketplace, because that's really the truth.
Yeah. Well, and according to this Capgemini World Health Report from 2017, the USA has the most high net worth investors than any other country, with 5.28 million people in that high net worth investor status. And that grew 10% year over year from 16 to 17. So I haven't seen the statistics of the report from 2018 yet. But it definitely, increased, and then globally grew 11.2% in 2017. So those are staggering numbers for the number of people that are in that high net worth status. You just got to get out there and find them when it's the right time as well.
Oh yeah, you're looking for you to be staggeringly successful. You need a percent of 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 that number, and they're everywhere. They are everywhere. I think that they don't identify themselves. That's why you may think they're not visible, but they really are everywhere. So, our database has over 1,000 accredited investors at this point. So they want properties, they want projects. Many of our projects close within 48 hours. It is about reaching out and building your credibility. And you can build that basically through the knowledge that you're being given in events such as this. Copy everything.
What was that coupon code again for your multifamily U boot camp? How can they get access to that again?
I'm going to go back to that one because they changed that code. It's not something that is common for us. So I'm going to go back. No, not here. Here it is. And that code is PROSPER. So if you would like to prosper, you can get $400 off of already a very, very low price.
And I'll put that into the thing here as well.
And that expires tomorrow at midnight, and still very inexpensive price, but why not take the $400?
All right. Next question. I went ahead and put that into the chat box so everybody has that as well. So you can have that, and it's in there for the history too. So in case we need to reference it later, we have that. Next question here is since real estate is local, if we have a quote unquote crash, do you think certain markets will be stabilized as Dallas-Fort Worth was in 2008? And any suggestions on what markets you think would stay stable?
The markets that are going to stay stable are the ones that have had the least construction in my mind. So Orlando, Vegas, Phoenix, Atlanta suffered the most. As a result, they had the most vacuum of new construction between 2008 and 2015. Since then, everybody's been building. The other one are the markets that have the most jobs. So Orlando has the most jobs. Boise has a lot of jobs. So really track the job growth. And there's many sites out there that track job growth. One of the things that the US government does do a good job of, surprise, surprise, is to track job growth. You don't have to look at 2-year-old job growth numbers. Go onto the web. There's sites that actually give you job growth numbers that are sortable. And they give them to you for every metro in the US. Track the jobs. What I've found consistently is that when you get into a bad scenario, it's the cities that still have positive job growth that you tend to do better in. You're going to suffer. Everybody suffers in a recession, but you're going to suffer a lot less. What I think is going to be problematic, and I'm going to get in trouble for saying this, is I see all of these people investing in these rough Midwest markets, whether it's Cleveland or Columbus. Well, Columbus, not so much. I'm going to take Columbus off the table, but you see Cleveland and St. Louis, and you see Detroit, and there's all these people investing in these markets because they've been doing really, really well in the last 3 to 4 years. Well, I don't think that that's going to be that way when a recession hits, because fundamentally these markets are weak. And right now, their fundamental weakness is being hidden by the fact that everywhere else is so expensive that money keeps flowing in. Well, if other markets become cheap in a recession, that money is going to stop, and it's going to stop very abruptly.
Next question here is Orlando and Jacksonville considered a tertiary market for multifamily, and how do you think they would perform in a recession?
So Orlando is no longer a tertiary market. So, with Yardi and CoStar, they're now upgrading Orlando to a secondary because it's crossed 2 million. So it is now a secondary market. Jacksonville is a tertiary market. So what was the last part of that question?
How do you think they would perform in a recession?
So it depends. So in my mind, Orlando is more likely to get hit. Jacksonville's a very diverse economy. Have you seen their pie graph? Every city has a pie graph, right? So when you see the Jacksonville pie graph, there isn't a big pie. As you can imagine, Orlando does have one very large pie. That's, Mickey and Friends. But what's nice about Orlando is that percentage of Mickey and Friends, the tourism piece, is shrinking every year. So you continuously keep seeing that shrink rate. Why? Because of the hurricanes. Jacksonville's the only real city in Florida that doesn't get hit by hurricanes. They've had one hurricane in 300 years, but the rest of the cities get hit. And guess what? When a category 5 hits ground, it tends to slow most of the time, not all the time. It'll slow and become a category 4 or 3 or 2. By the time it hits Orlando, which is, an hour and a half inland, then the storm has slowed. So a lot of other economies that are along the coast of Florida are actually moving operations to Orlando. So in the short run, yeah, next year there's a recession. Orlando is going to hurt more than Jacksonville. But I'm going to say that 10 years from now, if you're in for a 10-year term, 10 years from now, Jacksonville will hurt more than Orlando because Orlando is becoming so diversified. So it'll be more diversified and will be a larger economy than Jacksonville. Today, Jacksonville wins.
And last question here is do you have any information around the Bridgeport, Connecticut area and its tertiary surroundings?
Well, that's a very, very hard question to ask. In general, I'm going to make a general statement, and if you live in Connecticut, you already know this. Connecticut is screwed. Sorry to say this. From a real estate perspective, I think Connecticut has severe problems. I do not think that these problems go away. I don't think that they're recession related. I think they're macroeconomic problems that are not going to go away. So in the short run, every one of these states, whether it's Connecticut or Michigan, they have lots and lots of money. There's so much money to be made. But I don't find any reason to do buy and hold investments in a state like Connecticut that is suffering from severe long-term losses. Start reading about how many people Connecticut is losing to other states and how that loss is accelerating. So you're going into that market now. Now, having said that, I go back to what I said. There are individual markets in every state that are pretty strong. For example, Grand Rapids, Michigan is a very good market in an awful state for real estate investment. I don't believe Detroit's a good market to invest in, but I think Grand Rapids is. So if your market shows that isolation, if your market is not heavily cars or heavily one kind of industry, and it's very different from the rest of the state, go ahead and invest there. If not, then be careful.
Well, Neal, I really appreciate you taking some time to be with us today and sharing with the summit, and looking forward to having you come back at the next summit in June. So please mark your dates there, and we'll be in touch to get you on for that as well. I really appreciate your time.
Thank you so much, Dan. Great job putting the summit together. Thank you.
All right, we're going to go into a 15-minute break here. It'll actually be about 13 minutes. So we're going to start back here at 3:30. The 3:30 session is going to be with Anthony Chara, and the topic is going to be finding the right property management company for you and your property. So make sure you do stay tuned for that. During this 15-minute break, go ahead and go to nextmfin.com and sign up. We've already had over 100 people that are already registered for that event. So it's already going to be very, very popular. So make sure you attend. Many of them are going ahead and grabbing the VIP, which is half price right now. So for $197, you can get VIP access, or you can get regular access for $97. But that expires this weekend. So make sure you do it right now so you don't forget. nextmfin.com. And also, if to get entered into the drawing for a $500 gift card to Ruth's Chris, you can go to mfinsurvey.com and fill out that survey. As long as it's a complete survey, you'll be entered into that drawing for that $500 gift card to Ruth's Chris. So thank you so much, and we'll be back here shortly.